You, the mechanical version, not the geopolitical drama, because the mechanics are what tell you where capital is going to move and where the structural opportunity actually sits. If you find yourself learning something here that your financial advisor has never mentioned, hit like. It helps more people find this, and frankly, more people need to. To understand why the UAE's departure and Saudi Arabia's negotiations are as serious as they are, you have to understand what was actually built in 1974. Henry Kissinger flew to Saudi Arabia in the aftermath of the oil shock that produced gasoline lines around city blocks and inflation that nearly destabilized the American economy. What he negotiated was not a treaty. There was no signed document with an expiration date. It was a handshake arrangement, three informal pillars that restructured the relationship between American power and global energy markets in a way that has shaped every financial transaction on the planet since. Pillar 1. Oil would be priced in US dollars globally. Every country on Earth that needs energy, which is every country on Earth, must first acquire dollars to buy it. This creates a permanent structural demand for the dollar that has nothing to do with the attractiveness of American assets or the credibility of American monetary policy. The demand exists because energy exists, and energy requires dollars. Pillar 2. The petrodollar revenues accumulated by Gulf oil producers would be recycled back into US Treasury bonds. The dollars earned from oil sales would flow back to Washington as loans, keeping U.S. borrowing costs artificially suppressed and funding American deficit spending at a scale no other nation on Earth could sustain. Pillar 3. In return, the United States provided the Gulf monarchies with military protection, weapons, and political cover. You price oil in our currency and buy our debt. We protect your governments and your oil fields. This machine, invisible to most investors, operating continuously beneath every financial transaction on Earth, is the single most important reason the dollar became and has remained the world's reserve currency. Economists call it the exorbitant privilege, the ability to import goods more cheaply, borrow at lower rates, and run persistent deficits without the currency crisis that would destroy any other country attempting the same. And right now, all three pillars of that machine are fracturing at the same time. The first fracture is the UAE's exit from OPEC. And to understand why it matters beyond the headline, you need to understand the specific economics behind it. The UAE has invested massively in building oil production infrastructure capable of pumping 5 million barrels per day. OPEC's quota system capped it at roughly 3 to 3.5 million barrels. For years, the UAE has been operating a factory at 60% capacity because its business partners told it to. That tension became financially untenable, but the departure is bigger than production quotas. The UAE joined the BRICS alliance in 2024, the bloc of nations explicitly constructing alternative trade and payment systems designed to reduce dollar dependence. And when China is your single largest oil customer, the commercial logic of pricing those sales in the buyer's currency stops being theoretical. That logic is now policy. The second fracture concerns Saudi Arabia itself, the anchor of the entire arrangement. Those structured negotiations with China for renminbi-denominated oil contracts are not preliminary discussions. They are 10 to 20-year agreements being actively built. If they conclude, the foundational pillar of the petrodollar, that oil is priced and settled in dollars, will have been materially compromised at its source. India completed its first rupee-denominated payment for UAE oil earlier this year. Russia, effectively expelled from the dollar system through sanctions, has been trading energy in local currencies with China, India, and a growing list of partners for over 2 years. These are not coincidences. They are the cumulative result of individual nations making rational decisions about their own currency exposure after watching what happened to Russia in 2022. The third fracture is the one most investors are completely missing. China's holdings of US Treasury bonds have fallen by approximately 50% from their peak. China was once the largest foreign holder of American government debt. Its sustained, deliberate reduction of that exposure is not a market adjustment. It is a fundamental withdrawal from the recycling mechanism that has kept U.S. borrowing costs artificially low for decades. The machine is losing its fuel at every stage simultaneously: the pricing, the recycling, and the confidence that underpins both. Send this to one person who talks about markets but has never mentioned the petrodollar. Seriously, forward it. The number of investors operating without this framework is the real systemic risk. Here is where most financial analysis goes wrong about what's happening next. The countries reducing their dollar exposure are not moving into euros, yen, or any other fiat currency. Those are simply other paper systems with their own vulnerabilities and their own governments attached. The asset they are accumulating, in quantities not seen in modern history, is physical gold. Central banks globally purchased over 1,000 tons of gold last year. Poland, India, China, Kazakhstan, Brazil, countries across vastly different political systems arriving at the same decision for the same structural reason. And the reason is what happened in February 2022. After the Russian reserve freeze, every central bank on earth ran the same calculation. Gold held physically in domestic vaults cannot be frozen by a foreign government's executive order. It cannot be sanctioned. It cannot be made to disappear by a regulatory instruction sent to a correspondent bank. It has no nationality. It has no counterparty. And it has maintained purchasing power across 5,000 years of human history and every monetary system that civilization has constructed and then abandoned. The Roman centurion's ounce of gold bought a quality set of armor 2,000 years ago. It buys a quality suit today. The dollar that was worth 100 cents in 1971 is worth approximately 7 cents in 1971 purchasing power terms. The central bank accumulation happening right now is not a sentiment-driven trade. It is a rational, long-horizon institutional decision by the organizations with the most comprehensive understanding of monetary system risk. The people who manage national reserves, who have studied reserve currency transitions throughout history. When they move from dollar-denominated assets to physical gold at a pace not seen since the immediate post-Bretton Woods period, they are expressing a view about the long-term trajectory of the current system. And the scale of that movement is now objectively measurable in the data. Now here is the part most retail investors are fundamentally misreading about gold's recent price behavior. Gold does not primarily respond to fear. This is one of the most repeated and least accurate statements in financial commentary. Gold responds to real yields, to dollar direction, and to liquidity conditions. During the acute phase of any geopolitical crisis, several forces temporarily suppress gold's price even as fear appears to be rising. The dollar strengthens as global capital seeks the most liquid safe haven. Real yields rise as central banks freeze on rate decisions. And leveraged investors holding gold futures face margin calls, forcing liquidation of exactly the asset that looks most attractive on a fundamental basis. This suppression is mechanical and temporary by definition. It ends when the leverage clears. After it clears, gold reverts to reflecting the structural forces driving long-term demand. The de-dollarization I've described, the fiscal debasement of paper currencies, and the physical supply constraints of a commodity that requires years to bring new production online. 3 structural forces, each one measurable, each one accelerating. Let me be as precise about the investment dimension as I've been about the structural one, because precision is what separates a position from speculation. Physical gold, or unleveraged ETF exposure, is the foundational position for investors who want direct exposure to the de-dollarization, debasement, and diversification thesis simultaneously. It doesn't compound and it doesn't generate cash flow, but it maintains real purchasing power across monetary system transitions in a way no fiat currency has historically been able to match. Gold mining companies provide leveraged exposure to the same thesis with a different risk profile. A miner's revenue is determined by the gold price. Its costs, labor, energy, equipment, are largely fixed in the near term. When gold rises 25%, a miner's operating profit can increase 30 to 40% depending on its specific cost structure. This operating leverage is historically most valuable during sustained gold bull markets, which is precisely the environment the 3 structural forces I've described are building toward. The petrodollar system did not fail overnight in 1971. The Nixon shock that ended dollar-gold convertibility was the culmination of pressures that had been building for years. France demanding gold redemption for its dollars since the mid-1960s, gold outflows from the Federal Reserve accelerating, fiscal pressures from Vietnam, and domestic programs mounting. The shock was sudden. The conditions that produced it were not. The UAE's OPEC departure, Saudi Arabia's renminbi negotiations, China's 50% reduction in treasury holdings, central banks buying gold at 50-year record pace. These are the accumulating conditions. The shock that crystallizes them into an undeniable visible transition may not arrive this year or the next. But the investors who positioned for the post-Bretton Woods transition in the early 1970s, who held gold at $35 per ounce and maintained that position through the volatility and criticism that surrounded it, captured a move to $850 over the following decade. They were not rewarded for being dramatic. They were rewarded for understanding the structural forces before those forces became obvious in prices. The petrodollar is not dead. The dollar is not going to zero. The US financial system remains the deepest and most liquid in the world. But the unchallenged monopoly, the system in which every barrel of oil requires a dollar, in which every oil producer recycles revenues into treasury bonds, in which the exorbitant privilege operates without friction, that system is fracturing. The fractures are visible. The capital flows responding to them are measurable. And gold, which has always been the monetary asset that reflects the true cost of maintaining paper currency systems, is telling you something very specific about what it sees. The question is whether you understand it before the translation becomes obvious to everyone. If this breakdown gave you a clearer picture of what's actually moving in global finance right now, consider subscribing. I put out daily updates on the structural forces most investors aren't tracking, and the next video goes deeper on exactly where institutional money is repositioning before this becomes front-page news. When it does, it'll be too late to be early.